Introducing Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt 2AM. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hey, thank you, Jim.
The Bank of Canada hiking its trend-setting rate 0.5%. How does that translate into things like everyday loans and mortgage rates?
Yeah, so that was yesterday. That's up from 0.25 at the start of the year. They're now at 4.25. We haven't seen rates like that since 2007, and it's been in record time, right, in 9 months. So that impacts short-term interest rates in the banking system. So things like the prime rate are based off of the Bank of Canada overnight rate. So you've got a new prime rate, a retail prime rate, as of today of about 6.45%. You've got things like HELOCs. They float as well based on prime, and the average HELOC loan is just under 7% today, Jim, about 6.95%, and that compares with 2.95 in March. Variable rate mortgages also are impacted, so things that were sort of 1.5 in March are now closer to 6. And 35% of Canadian mortgages are coming up for renewal in 2023. So just with the rate hikes that are in the system already, the 5-year and 10-year bond prices are really the thing that impact the fixed rate mortgages, not the variable. The Bank of Canada rate really just impacts the front end of the curve. So fixed rate mortgages, we'll see. It's interesting because, for the last several months, the Canadian bond market, the U.S. as well, but Canadian bonds have actually been rallying in price, rising in price, and that, in effect, lowers the yield and therefore pulls down mortgage rates on the fixed term side. So mortgage rates should be coming down on the fixed term side, although probably not as much as people would like, considering the amount of price pressure they're under right now and the huge spike they've experienced year to date. But the banks are often slow to lower the rates as well, right? Because they've sort of take a while for it to feed through. But I mean, on the upside, I suppose, is that the fixed term mortgages are starting to come off again, and I think that the bond market is really saying that there's been so much tightening put into the financial system in 2022. And as the Bank of Canada itself says on its website, it takes 1.5 years to 2 for the tightening or the moves that they make on monetary policy to filter through the economy. And it's for the reason that I've mentioned. Not all debt is floating and influenced by increases or decreases in the front end of the policy rate. And a lot of them are, in Canada, as I said, 35% of mortgages are locked in presently, so they haven't yet been impacted by higher rates this year, but they're coming up for renewal in 2023. So that's where they could be facing some very stark increases. And then overall, the Canadian economy is so highly levered today that it is facing a very sort of grim outlook in 2023 as the global economy probably is entering its next major recession, and Canada is less prepared for this one in terms of its vulnerability to the downside here than it has been since probably the early 1980s. that was the last time that we went into a recession with a massive housing bubble. And what we know about housing bubbles is that when they burst, they tend to, lead the worst economic contractions. They're the most impactful because 66% of Canadians own a home. The bulk of household wealth is reflected in any equity they own in that house. And they are the most highly levered asset class, real estate, worldwide, not just in Canada. That is where, economies like China have also had a monster of a real estate bubble. And in the U.S. too, although less than Canada this time, which is ironic, since we were a lesser bubble than them in the 2007 fiasco. But anyway, the point is that the bond market has been, as the central banks are raising on the front end, the bond market has actually been increasing the price of bonds, which is a vote saying, hey, you guys are pushing the economy into a recession. And you see that in things like an inverted yield curve. So, for example, in Canada today, the 30-year bond is yielding 2.77, and the 3-month Treasury is 4.21. That is an inversion where long rates are paying you less than short rates to the tune of 1.44%. That is a massive inversion. We have not seen anything like that for at least 40 years. And still we have central banks tightening into, a major global downturn where inflationary pressures are coming off, but not, of course, it's a lagging indicator, so not super fast, but they are definitely coming off. But the central bank is still wanting to increase rates in the face of this massive inversion in the yield curve. Again, the last time that ever happened was in the early 80s, and we had actually 2 double-dip recessions back-to-back. 80 and 1981-82. So I think that, that's the kind of environment we're in here. And it's not just mortgages, of course, because a lot of floating rate debt is in, lines of credit cards themselves. A lot of people are holding balances, record credit card use today, record balances, and rates above 20%. I mean, these are just horrendous situations for people to be stuck in. And that's before they even have to face the prospect of job losses. Already, though, we're seeing a contraction in hours worked in terms of the amount of employment people are getting, and multiple job holdings, people reporting that they're trying to make ends meet by having a second and third incomes. The personal savings rate is at an all-time low. So these are all sort of really bad conditions to go into a big recession where we know that unemployment always increases by 1% or 2% at least. So when people start losing the ability to make, income, that's when the default cycle should really pick up.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, it was hard to find a new car or a used car at a reasonable price. We're saying the supply chain is coming back, but with higher interest rates, will there be a rebound in auto sales?
Yeah, so that's another sort of hangover from the time that was. So remember during the pandemic, no one wanted to take public transportation. They were concerned about contagion, and they were very inclined, the ones that were working away from home or traveling outside the home, to want to have individual vehicles. So there was a big push that helped by the fact there was a bunch of free money given out by the government and that rates were slashed to all-time lows, and suddenly there was a huge interest in purchasing vehicles. There was a period there from late 2020 into late 2021 where the demand for vehicles was so high and unusually high that you couldn't get some of them, right? Remember, we had a shortage of things like semiconductors, which held back some production of some vehicles, and a lot of people were putting in orders for new vehicles which weren't yet available, and sort of the supply chains were buggered up, and there was a lot of things in transit and all that sort of thing. So there became this frenzied obsession with trying to get vehicles. Not only that, but a bunch of people opened up sort of side hustles because they figured out that you could order a car and by the time it was delivered, you could sell it for more than you received it, for more than you paid for it. So we did see a huge leap in used car prices, which, as you know, Jim, from your life experience, is extraordinarily unusual. Normally you buy a car, drive it off the lot, and it's worth less than you paid for it. In this brave new world, cars were actually selling, even used cars. My son bought a used car in late 20 and was able to sell it at a profit a year later. So it was a very unusual time. Of course, people have short memories or no memories, or they become swept up in the mania of the moment, and so they were doing a lot of used car trading was at an all-time peak. Auctions saw a lot of vehicles going for exorbitant prices. Well, in the last, for 6 straight months now, we've seen used car prices fall. They're down 14% year over year. It's the largest decline on record. And there's a bunch of factors at work there. First of all, it's the interest rate impact, which I spoke of. So auto loans definitely are impacted by rising interest rates, and so financing has suddenly become much more expensive and difficult, and that same type of math applies to leases as well, because they are ultimately based on the notional interest rate. So the financing of vehicles has become much more expensive, just as the price of them was ridiculous. So it's kind of like housing, right? The low interest rates allowed housing to become so expensive, just like it pushed up the price of cars. And now the opposite is happening as well. As the interest rates have changed so much to the upside, prices are having to come down because no one can afford to buy them. So there's that's impacting it. There's also production has finally caught up, just as demand is coming off. Inventories that are at record highs. A lot of car lots, we were tracking this even 6-7 months ago. We're sitting with record volume inventory, and there was a reluctance, just like in the housing sector, a reluctance for dealers to cut prices or lower prices because they were thinking of the good old days, and they were like, no, we're going to get back to that time when we can get these really high prices for this product. But they're sort of denying that the change, the cycle has shifted, and for a long time people want to just pretend that it hasn't, and then they keep things off market or pull properties back or pull cars off and store them. But essentially what happens in this high interest rate environment is a lot of dealers are also getting squeezed, right? So it's expensive to store product. They have high inventories, which are expensive to insure and to keep on lot. And so they can only sort of put it off for so long before they have to start trying to liquidate their inventory. We have a distressed dealers now that are starting to liquidate cars, and other dealers trying to buy them up, right? So the ones that have cash, this is a classic credit cycle, the ones that have cash and liquidity are now in sort of the strong hands buying off the weak who didn't do this cycle right, went into it too levered and thought that there would never be an end to the escalation in prices. So you've got a credit crunch going on now on dealers with excess inventory. That's also something that tends to push down prices because you get liquidation selling where they put blocks of vehicles up. And so the other thing is that, with the EV market, during the spike in the price of gas and oil since the Ukraine war, the spike in the cost of fuel really made people think, hey, the next car that I buy, I want to try and make it electric. So we've seen that in the consumer reports. We saw a lot of people holding off to try and buy electric vehicles. And then, of course, for a while there, they too were going up in value, which was an anomaly. You could buy it and it would be worth more. So now what's happened is the Inflation Reduction Act in the United States, they've brought back in a tax credit, which will be starting in 2023, for plug-in electric motor vehicles. So that also is an incentive for people to hold off buying cars right now and try and wait until the new year where they may be able to get a tax break. So the other thing with electric vehicles is, for example, Teslas and that sort of thing. Since a lot of people bought them in 2018, those have a 4-year, full factory warranty, and they've come up recently. So people are now looking to try and sell those vehicles, before they go off the extended warranty. So all that is really pushing forward a bunch of excess capacity and inventory onto the market. Prices are falling, buyers are in retreat, and sellers are plentiful. So that's always the conditions for lower prices.
Elon Musk's controversial takeover of Twitter, has that encouraged or owners of Tesla products to return it or sell it or not buy one?
That's news to me. I think that's one of the most ridiculous things I've ever heard. No, like I said, there's legitimate reasons for why all cars are in excess supply and why people are starting to sell, or looking to sell, but also why they've been holding off buying vehicles in this particular environment. So Tesla is just like other car makers in that, they're not immune to those conditions, but it's got nothing to do with Twitter. I mean, I find that some people have a very confusing, way of conflating Elon Musk, the individual, or their perception of him as a person, with all of the products and companies that he's associated with. You can not like him, you can think he's crazy, you can think he's genius, whatever it is. The reality is that these companies have, enormous success in a lot of different sectors. And for me, myself, I can separate what my impression of a person I don't even know, but just from what I read in the media of a person, I can keep that separate from the business model of the product, the math of the sector they're in.
Danielle, anything else that we should be keeping a close eye on right now?
Well, I guess coming into the end of 2022, it's been a difficult year for a lot of people in their portfolios. Their net worth's taking a hit because they're seeing not just the price of their real estate go down, but a lot of their securities. There's been this expectation all along that it is sort of, there's been a buy the dip mentality throughout. There's been a lot of people that have been continuing to try and speculate in financial markets. We have not yet seen liquidation selling from the retail side, which is, they've been really stubborn in their participation this time. And I think that's because of the years of training in the prior period where, every time things would go down, you'd see central banks capitulate and start, pumping liquidity into the system again. They're not doing that this time. This is, like I say, a brave new world. And I don't think they're going to start doing that early in 2023. They are still very adamant that inflation is their bogey, and they want to see the long-term trend, albeit a lagging indicator. They want to continue to keep conditions tight until they break the back of this speculative mania that has driven prices in the last little while. And so I think people have to appreciate that the path of least resistance as we go into the new year is actually to have the economy continue to slow, to have revenue and profits fall, to have corporate earnings compress, to have employment rise, and to have asset prices continue to fall. So if you can maintain liquidity, cash, like government bonds are one of the few areas that do well in that environment, and they've actually been fulfilling that destiny again of late. The Canadian economy, as I said, is likely to have a tough go. The Canadian dollar could significantly weaken. Things like the price of oil. Today it's under $72 again, Jim. It's given back about 45% now from its peak in March, and it's back to where it was in 2018, long before COVID, long before, you had any invasion in the Ukraine. So I just think people, if they could just appreciate that there are many secular factors and cyclical factors that are driving what's happening right now around them in terms of financial markets and the economy. And to, if they can move away from this idea of, it recovers really quickly. It doesn't necessarily recover quickly. And in fact, real estate downturns are often prices fall and stay there for many years. That's a typical outcome. So just some appreciation of historical context and what we're facing and why, the reasons for it, and the opportunities that come out of this for people that can, maintain their not lose their shirt, not be speculating in cryptocurrency and all the craziness that goes on there, the abject fraud. That emperor is stark naked and has been all along. And a lot of people got sucked in there. So just trying to keep your eye on things that matter, on being frugal, on not wasting, on keeping cash reserves, on paying down debt. If you have the option to lower your leverage, it is still not too late to do that. And that means, because I think what's going to happen in 23 is, as the Bank of Canada says, the lags are 18 to 24 months. So whether they start cutting again in the latter half of 23 will really not be here nor there in terms of the stress that's going to continue through levered parties today. We're seeing it in REITs and Blackstone's real estate investment trust. A bunch of gates are coming down. Liquidity's drying up. A lot of these whales were the only buyers of properties in certain sectors. So this mirage of, great prosperity and lots of liquidity and everybody throwing money around, that is not where we are now. We're in the cleanup phase of that. And so that means that a lot of things that looked like they were sure things are going to be revealed to have been bad bets. And there's going to be liquidation selling of all sorts of things. So preparing for that is the sort of art of how you survive and thrive in this environment. And like I said, lower prices are actually the solution here. It's ultimately good. Yes, we'll probably get central banks back to wanting to ease financial conditions in the second half of 23, but that will not be a quick fix. It will not suddenly save all the people who have come into this over-levered. And it'll take several months thereafter for the economy to sort of turn around. So we should expect that you could see a year to a year and a half of a sort of a downturn as these conditions unravel.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. If you have any questions for Danielle or any of our guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.